The global monetary system is caught in a long-term designed addiction to debt. Governments, households, corporations and the financial sector that profits from it are burdened with enormous obligations that will never be repaid in any real sense. The usual response is to borrow more, rearrange the liabilities and hope that confidence actually holds. The structure resembles a chain of promises that must constantly attract new currency to come on in and belief to sustain itself. But as we're all aware, the global monetary system runs on promises it simply cannot keep. Currency is debt, and this currency is created when credit is issued. Governments, companies and households are trapped in a cycle of borrowing. That will end, but not for some time yet. The structure that has been built is one that survives only as long as new currency and confidence keep flowing in, and this is the key to how they will keep their illusion, their Ponzi scheme alive. This video explores 7 methods, some of which are entirely new, that they will use to keep the debt Ponzi system alive. Even without formal quantitative easing, central banks and treasuries remain closely connected. Maturing bonds are rolled over, liquidity facilities keep markets calm, and the entire financial system operates on the quiet expectation that central banks will step in if yields rise too high. At the same time, governments are shifting towards ever shorter term debt to manage costs, effectively refinancing the state every few months. While of course every crisis has deepened the integration between the state and the financial oligarchy. The balance sheet grows less visibly, but the dependence remains, a subtler version of money creation that hides behind the illusion of normalization. Financial repression, it sounds technical, but in reality it simply means that savers lose quietly, while the state as the principal debtor wins. Authorities keep interest rates below the rate of inflation, which steadily erodes the value of savings. And of course, I mean real inflation levels, which are far higher than those claimed in official statistics. The impact is reduced purchasing power even when you save. Yet for the government, the real burden of public debt is managed, making it easier for the state to refinance. Pension funds and banks are required to hold more government debt, and this channels private wealth toward public financing. In all, this is a silent transfer of value from households to the state. A system built on debt cannot shrink without collapsing. Credit must, of course, continue to expand. When regulated banks slow down, less visible credit channels grow. Hedge funds, private credit vehicles, money market funds and other intermediaries create debt-like instruments using collateral chains and short-term funding arrangements that imitate money creation outside of the reach of regulators. For instance, US bank loans to non-bank financial institutions reached approximately $1.2 trillion in March 2025. Now that's a 20% year-on-year increase, while overall commercial loan growth was only about 1.5%. As we've seen repeatedly, every downturn brings new support facilities to prevent contraction. Old debt is rolled over and repackaged, so the total level of leverage keeps increasing. Digital money is promoted as modernization, inclusion or convenience, but it also gives financial authorities new instruments of control. Central bank digital currencies will allow money to be sent directly to individuals as UBI payments. At the same time, they can embed rules on how and when this money can be spent. Now, this programmability really represents the securitization of human behavior, knowing as these systems evolve that tax can be automatically calculated and deducted at source. Tokenized bank deposits can trade on digital networks, adding liquidity and possibly making resolution of failing banks easier. Large stable coins already represent a parallel form of dollar liquidity, and we can expect their market share to grow rapidly. Regulators aim to bring these private systems under official supervision so that they can be used as managed pools of capital rather than uncontrolled alternatives. Meanwhile, the volatility of crypto markets facilitates the need for apparent stability courtesy of US debt-backed stablecoins. Together, these technologies broaden the range of ways to create and manage money. As previously discussed here, governments, global institutions and large NGOs are developing systems that treat natural resources as financial instruments. Perpetual financialization seeks collateral everywhere. So as traditional assets have all been securitized, it means that non-human systems become collateral. This effectively turns the argument of preservation into another financial arbitrage opportunity. Carbon credits were the first step, where tradable units represented the right to do environmental damage. Now we see calls for the tokenization of ecosystem services. Of course, they promise conservation, but the reality is that forests, wetlands and other natural resources become balance sheet entries, all under the guise of greenwashing. Yet for governments, it's a fiscal strategy where assets can be monetized, offering revenue streams from nature credits. The potential of debt for nature swaps and leverage for new borrowing. This is a rebranding of austerity as sustainability. When government borrowing approaches its limits, attention turns towards private savings with great envy. Policymakers and institutional puppets such as Larry Fink talk of unlocking private capital. In reality, this means directing pension pots towards heavier weighting of government debt. Of course, stablecoins will be used to turn depositors into proxy holders of US Treasury debt. And with leverage, the market for these stablecoins could grow enormously. While for CBDCs and tokenized deposits, sovereign debt will remain the core collateral because it is said to be the most credible, liquid and politically guaranteed asset. The digital equivalent of gold, the institutional anchor of a credit system that runs on trust in the state. So we can expect insurers, sovereign wealth funds and emerging market central banks to carry increasing amounts of the load. And as discussed numerous times, we've seen an increased desire of major central banks to outsource sovereign debt risk via quantitative tightening and to redistribute the ownership of debt. If reality ever threatens confidence, definitions can change and rules can be easily rewritten. As we discussed here, banks who are effectively forced to hold government debt via banking regulations value this debt at held to maturity levels on their balance sheets rather than current values, which have collapsed, of course, since 2020. Debt ratios can be fudged by moving liabilities off the balance sheet. Revisions to economic data have often arrived long after publication, and market rescues can be described as temporary liquidity facilities. While stablecoin issuance will not count towards traditional money supply aggregates, this helps to actually manage government debt by monetizing it privately and off the books. None of these methods, of course, resolve the fundamental imbalance between debt and the real production level. They simply seek to extend time and maintain the appearance of normality while underlying fragility grows. The obvious consequence for those unaware is a gradual long-term loss of purchasing power and a steady transfer of wealth from the public institutions that control the flow of credit. Ex-Soviet spy Yuri Bezmenov claimed that the aim of propaganda is to distort the perception of reality so that people can no longer think critically and make rational decisions. That is a dynamic which remains true now more than ever. So do make sure you question everything. Now, I hope this has been an insightful video. Do check out the other videos on the channel. I look forward to seeing you next time. Bye bye.